Hi, everybody. Good afternoon. This is Alex Tapia speaking, and I want to thank everybody for joining us today on our Zoom call to talk about everything that's going on in the market since the beginning of this year. But before we get going, I'd like to ask everybody if you could mute your microphones. That will be very helpful since we expect quite a few people on the call, and it will be helpful so that there's no background noise that's unintentional, as usually happens on these types of Zoom calls. So once again, I want to thank everybody for joining us. And you know, it's 4 o'clock, it's late in the afternoon, but we thought it important that based on everything that's going on, fill you in on kind of what we're thinking and what we're seeing. And obviously we're watching all this stuff very closely. I think with everything that's going on in the world, it's important to kind of maybe put things into perspective and kind of talk about also what we're seeing, but maybe what we might be doing in the future and what we're thinking about as far as any changes, if any at all, that we need to make to our portfolios. But in general, obviously, everybody knows there's all the major culprits for what's going on. I think one of the biggest one is probably the war in Ukraine with Russia. That's creating a lot of volatility because of the uncertainty that brings, and especially towards the emerging market sector and just really around the world, because it seems such a volatile event where it's taking longer than anybody really anticipated, and it's being dragged out. And so that's obviously spooking the markets, the oil markets as well, and with the supply and all those types of issues. And then, of course, you also have an inflation that's been a big part of the negatives that we've been seeing, has risen a lot more than a lot faster than anticipated. And I think everybody pretty much knows the reason why that probably has happened. We're printing money like crazy, and somebody has to pay for all the free things that we had, all the programs that were created during COVID to keep everybody afloat. And now that's coming back to somebody has to pay for that. And so inflation's going up, and then there's supply chain issues, and all these things are piling up on each other and creating a lot of negative news and negative markets. I think it's important to note that the markets are not really yet in recession territory or anything like that. They've retreated, I think, as of Friday. And Andrew and David can correct me on this. They're down about 15-ish%. I know the NASDAQ, the technology sectors, are down over 20%, and that's pretty significant. So we're hoping to shed some light on maybe why all of that's happening and kind of give you the state of the environment that we're in. We've got David Muller on the phone with us. He is our portfolio manager and our research guy at the office, and he's going to do a little bit of talking, give some technical information. And then Andrew Oak is on the phone with us as well, along with Melissa Brennan and Austin Sutton. And then when David is done, we're going to bring on Carl Burgoyne to give his perspective on the markets as well. So without further ado, once again, thanks for joining us, and we'll go ahead. And David, can you hear me? And if you want to unmute yourself. So what are we looking at from the technical standpoint, and what's going on with the markets as a whole?
Well, let me get started here. I promised Andrew and Alex I wouldn't bore you to death with a whole bunch of charts and graphs, but certainly there's some that we need to look at. And what we're looking at on screen, just like Alex was saying, that we may be down 14-15% or so in this correction. And I just wanted to look at a little history, of course, because this is not the first time a correction has ever happened, as we all know. And so this is a good chart that goes back basically to the beginning of 2008. And you can see down here on the bottom all these various correction periods, which are these shaded blue and somewhat red bars. So we've had, on average, corrections. If we go back to even 2010, we had a 16% correction back then. We had a very, very small correction in 2013. I believe the broad market was up 32% that year, and there was only one short period of 34 days that it was down 5.8%. A couple of years after that, in the middle of summer 2015, there was a period we were down 12%. And probably the more significant one that's happened here recently is during Q4 of 2018, which is here, where we were down 19.8%. A lot of people forget that, and that was just a couple short years ago. So corrections happen. What we're seeing now is not at all out of the ordinary relative to history. You can even go back further in time, but I think this drives home the point that markets fluctuate. Now, people say, well, David, don't you, World War III is starting, so maybe we need to think about something else other than a normal market correction. And that's what this data shows here. And I'll just, if you look at the far left-hand column here, this takes a look, and this, I could only find data going back to the end of 2013, but this makes the point I want to make basically. If you look at large US equity returns, basically S&P 500 or Dow companies, from 1926 to 2013, basically average annual return was 10%. If you go back to World War II, the average return during World War II was actually 16.9%. Now, it didn't start out that way, which we'll look at in a second, but over those 4 years, returns were almost 17%. Same thing in the Korean War. Now, during the Vietnam War, we had less than that 10% average return of only 6.4%. And during the first Gulf War, it was 11.7%. So I point this out to say, again, David, don't you understand World War III is starting, or it's already happening? And I say, well, as horrible as that is, that surprisingly, if you average all those war periods together, on average, they've actually been a slightly higher return than we've normally experienced. Again, looking at this data from 26 to 13, basically 10% equity type returns. Now, obviously, like I said, it didn't start out that way. So I just wanted to point this out as well, is basically at the end of 2000, or at the end of 1941, right here we had Pearl Harbor, of course, and this is actually a chart of the Dow. And if you really want to blow your mind, back at that time, the Dow it started at 130, and the Dow is now 33,000. So that should be a huge testament to anyone on this call. Over time, equities have tremendously compounded people's wealth. But that being aside, you can see after Pearl Harbor happened, there was, yes, a significant down move of almost 20 or so percent going into 42. But for the remainder of that time period, after the Battle of Midway and the rest of the World War II period, actually equity markets were up. So not making light of the situation, obviously it's horrible, but at the same time, that doesn't mean that the entire global economy implodes. Now, speaking of that, has anything changed since the beginning of the year as far as big picture economic indicators that I look at that give us an idea of what the future may hold? And this is one of them. We've talked about this many times before, the leading economic indicator index, which is the squiggly blue line here. And so how you read this is there's years on the bottom, and then there's percentage change, plus or minus over 0 on the vertical here. And you can see, so leading economic indicators, 10 different indicators. It looks at things like manufacturing new orders. It looks at new credit growth, stock prices, even the shape of the yield curve. The ISM manufacturing survey is also in here as well. And basically tells you, hey, are these leading economic indicators trending positive or negative? And you can basically see if they're above the 0 line, they're still positive. We haven't got the March or the April data yet, but as of March, this is still quite positive, as you can see here. In the last recovery period, which was quite a long time, you can see there were ups and there were downs. I mean, we slowed down to maybe a 1% or so year-over-year growth rate, and then it increased. Kind of going into 2015, you saw it slow down again, and it got almost negative here, but then turned around and went positive. So you can see that where we are right now is not really an area that concerns us too much as far as future economic growth. If this thing got down close to the 0, we'd be having a different conversation, but we're not close to there yet. Another huge thing is obviously the shape of the yield curve. And without completely boring you, basically how you read this chart, it's looking at the difference in yield in the treasury market. So the difference in the yield with the 10-year treasury bill minus the 3-month treasury bill. And that is a number, which is what's graphed on this chart. And you can see this goes back multiple cycles and multiple decades. And where we are right now is we're pretty close to 2% differential between the 30-year, which just hit 3%, and the 3-month T-bill. Now, obviously, with the Fed increasing rates here for probably the remainder of this year and then through next year, obviously this line will probably come down, but it's a great leading indicator, as you can clearly see that it gets pretty close to 0, meaning there's not that much difference between the 3-month bill rate and the 10-year rate. prior to problems happening, which are these vertical shaded areas which corresponded with recessions. So again, we started the year, this was pretty high. It's actually increased, again, that differential. So as far as I'm concerned, at least this, you can't take one measure in isolation, but there's a couple things that we look at for big picture outlook on the market. And this one here, it's actually similar to where it was at the beginning of the year. So I don't think the yield curve is telling us to get concerned too much. There'll be a time when it will, but that time is obviously not now. And obviously the news is making note of a negative GDP print for the Q1 of this year. So let's just talk about that. What you're looking at on screen here is this is quarter over quarter growth rates for GDP, which is a measure of economic growth. And you can see we're going back a couple years here. And what I want you to take away from this is the US is an advanced economy. The GDP growth rate on a year-over-year basis is highly unlikely to be much above 2-something% GDP growth. It's definitely not going to be sustainable above 3. And you can see if you go back prior to 2020, which obviously government intervention helped make GDP extremely negative, as you can see here. This was Q2, sorry, of 2020. But even prior to that, just on a quarter over quarter basis, we should be somewhere in the 2s, which we kind of were here. And you can see, obviously, the government action dramatically decreased GDP. And then the following quarter tremendously increased. And you can see it's been elevated on a quarter over quarter basis. We should not be in the 6s, or at least it's not sustainable. And so what we're really comparing is Q1 here to this period, 6.3, which that is not a sustainable growth rate for GDP. So you're really just seeing a slowing back down into the normal range of where GDP should be. And if you want an estimate of where we think it is, like this year, we don't think it's going to be much above 2% GDP growth. The Atlanta Fed has a good, what they call GDP Now estimate. It's shockingly accurate in the short term, but what they look at is data right now, and they have some mathematical adjustments that they do to it and say, okay, based on what we know now, what might GDP look like in the next quarter? And you can see, and they plot it over time, at least from the end of the prior quarter. So there's not a ton of data here, but what you're looking at is this green line right here. And it's slightly under 2%, which is not too far out of the range, but I would certainly say GDP should be positive in Q2 and probably Q3 and Q4 this year as well. So again, nothing that's outright, none of these big data points are in areas that are getting us very much concerned at all. And then if there is a period to start getting concerned, that might be maybe more a year or two in advance from now, not right now. And so this is a graph of just the Fed fund rate. And these colored bars are just highlighting periods of, this was in the blue 24 months, or basically 2 years ahead of a recession and 1 year ahead of a recession. And you can clearly see that the Fed is starting to raise rates. They're actually going to raise rates again on the short end here this week on Wednesday, or announce that they're going to. But just the fact of them starting does not really mean negative results immediately going forward. As you can see here, there's quite a period where rates go up. And if you actually look at what were asset returns during these different periods, that's what this chart is right here. And I just call your attention to how have stocks done 1 and 2 years prior to a recession. And while they and Andrew's going to elaborate on this, while they have not been 20+% multiple years in a row, like we've actually just had, we're still high single digits for equity returns. And we'd argue that those 20-something plus returns were unsustainable, but it doesn't mean that immediately you start to have bad results. And we certainly think that this drawdown should be an opportunity to add to equities or make some changes that Andrew's going to talk about, kind of what we have actually done already. And then finally, I just want to wrap up with, well, where did we think the market was going to be in the last couple of years? And so this is a chart of, this is last year, of what Wall Street thought as far as price targets. You can see there's a range on here from a low of 3,800 to a high of only 4,400, I point out. we think the market actually got ahead of itself at the very end of the year, and it went up to 4,800. So part of this pullback that we saw is actually just reversing probably a too high a point that we got, because you can clearly see no one was anywhere close to 4,800. I thought 4,200 was my target, so that's kind of somewhere in here. But we were up at 4,800, and we've had a correction back, and then a further correction from that. And so obviously, where does that look like this year? This is what Wall Street thinks as far as S&P 500 price targets. You can see we were just a couple days at the end of the year. We were almost right at that 4,800 right here. And you can see there's a huge range, 4,400 with Morgan Stanley, which so far they seem like they're right, but we have a long year to go. And all the way out to, looks like Oppenheimer's at 4,300. I think 5,300. And I think 5,200 is fair given our outlook, because we're still going to have earnings growth. And as soon as we get out of this correction, I think people are going to be surprised how quickly market moves back in the other direction. Again, but a year is a long time. So as far as opportunities, Andrew's going to elaborate here in a minute, but certainly if we have cash to deploy, it's certainly a very, very good entry point to the bond market. With existing portfolios, Andrew's going to talk about some of the moves that we've made, but certainly some of the stuff that we've already done year to date has cushioned the down, especially in fixed income, quite significantly, and positioned us, I think, in a really good spot going forward. So Andrea, you may want to elaborate here on some of the actual moves that we've made on a year-to-date basis.
Yeah, thanks, David. And again, we wanted to kind of give you a couple more technical reference points that are certainly relevant to what we do, and then kind of tie it back around to obviously everybody's specific portfolios and mindsets. You know, no one likes watching their accounts go down in dollars or percents. We're certainly invested the same way as you guys, or a lot of you. So we're in the trenches with you, but we also have the benefit of seeing a lot of different circumstances and a lot more technical research on a daily basis. I heard a very interesting quote the other day, and I kind of wanted to reference it, and it was said that nobody lives in Chicago without owning a winter coat. And we kind of liken that to our investing approach and kind of always trying to plan for downturns where we're never forced to sell something at a loss if at all possible. But keeping with the analogy, sometimes when it gets cold overnight, you still have to spend a couple minutes to go up in the attic and pull the winter closet down and put the summer stuff back up. And so that's kind of what I would liken to this little period we've been in the last quarter and a half. Is certainly there's some winds of change that have been accelerated with some of the Fed changing of their tune in terms of their pace of play of raising interest rates. Certainly the invasion of Ukraine poured fuel on the fire in terms of the equity sentiment that previously was actually, as David mentioned, had a lot of positive fundamentals going on beneath the surface. I don't think inflation was a surprise to anybody or the need to raise interest rates. But again, the dynamic of how fast and combined with the Russia-Ukraine conflict is really kind of where we're at today. So I wanted to also add to that some interesting data points. This time last year, I want to say roughly May, is about where the market, when I say the market, roughly the S&P was this time a year ago. If you remember and think back to what you were doing in May of 2021, I don't think anyone was worried about the direction of the market. If anything, people were clamoring for, again, injecting cash and riding the wave because the market has been on a tear, and our memories are just, as humans, naturally short. So we wanted to all participate. When you put that in perspective, it's really very different in terms of trends when you're watching your account go down from a market peak, which was January 3rd, just a few days past 80 days ago, a very short time frame, to now, where the market has obviously dropped from peak depending on the indices. I'll just have a few here. The S&P 500, as we've talked about, is down roughly 13.31%. The NASDAQ is down 21%. The Russell 1000 is down 15.96%, and the Russell 2000 down 17%. Even the U.S. Aggregate Bond Index, typically a place for safety and equity volatility, is down almost 10% year to date. Last year, calendar year of 2021, the S&P was up 28%. The NASDAQ was up 27%. the Russell 1000 was up 26%, and the Russell 2000 was up 14.8%. So when we talk about perspective, and this is not just us, this is everyone, it's very different to see coming down from a peak and hitting certain levels than it is coming up to meet those levels and then the perspective beyond that. So our job as your advisors is to have that long view, to be able to look past today, look past next week, look past next quarter. And that's what I wanted to kind of point out some things. It's a fair question to say, well, what have you guys done, or what are you going to be doing going forward to keep my plan intact? I don't know if you recall, we have some new clients on the phone as well, but back in January, we tried to make some moves in anticipation of predominantly interest rate rising environment. We rotated some of our fixed income positioning that had enjoyed a much higher yield, but with a little bit more risk globally, and rotated those to one of our current positions, which is largely mortgage-backed securities. We also took some of our other fixed income and equity exposure globally and pivoted it to floating rate bonds for banks, or for bank loans, excuse me, in addition to high quality U.S. companies, predominantly large cap, mid cap, small cap, so total market. Those trades don't look sexy right now, pardon my French. They actually, if you compare them to what the positioning was in January, actually were effective in beating what the former allocation was. Emerging market bonds are down 2 to 4% more than they were in January in our current position. So if we would have held that position, you would have seen a much more dramatic increase on the bond side to the downside. Same thing with emerging markets. Again, with the Russia-Ukraine invasion, that sector is down even more than the S&P 500 and some of the large cap positions and mid cap positions and small cap positions that we rotated to in January. So what we've done, or what we tried to do in January, was position ourselves the best moving forward. And I think we are actually effective in those, even though it's not necessarily translatable on your monthly to month or on your month to month statements. One of the things that is also a fair question is why bonds? Everyone is used to hearing that the bonds are safety in relationship to the equity market, especially in volatile times. One of the reasons for bonds is because of the stability the income provides. I don't have a formal metric on this, but I think this is one of the worst start to a years for bonds ever, and they've actually been moving down along with equities, which is typically not the case. In the short term, these total returns on bonds are down for both of the positions we have, but they're also positioned to react favorably in a rising interest rate environment. So one of the positions we have, just to be more specific, relate to the ability for banks and mortgages, quite frankly, to renew at higher price points and collect higher interest as interest rates rise. So in other words, we're able to capitalize in a rising interest rate environment. So that's why bonds, is because they still have a place. Ideally, you collect the interest from a bond. You are able to, I don't want to say ignore, but have a lower tier priority on the price fluctuation, because as those bonds mature over time, you're able to redeem those at basically par value, or what they're actually worth, and you get to collect the interest along the way. So the interim price movement is less of a catalyst, not necessarily day to day or month to month, but over the life of a bond portfolio, actually still provides that stability, which is why they still have a place in diversified portfolios. We have some other equity things equity positioning that we've done as well that are positioned, quite frankly, well. Like David said, if there's cash on the sidelines, the priority would be bonds, because those are pretty much riding on the wall to bounce back fairly quickly as inflation not necessarily ever comes back down to 2%, but normalizes to a more stable position than where we spiked this year. And actually equities, while they're certainly down, still have a relatively high value in relation to their peers based on price to earnings, and so aren't quite as good of a buy right now, even though obviously equity exposure is still projected to rebound, as David pointed out, closer to year end as some of these short-term forces flesh themselves out. So just wanted to kind of point on that. Obviously, as we've said before, specific to your portfolios, we encourage you to give us a call. Every client is different. You're as unique as your own fingerprint, and we customize your investing approach to you. So please give us a call to have a one-on-one, but I wanted to at least kind of parallel on what David was able to outline from a broad market perspective and add a little color around what we've done since the beginning of the year and what we're looking at going forward as well.
That's great, Andrew. Thanks. Can you hear me, by the way? Okay. Yeah. Great explanation. And we're going to have Carver going come on here in just a second. But just to put all that stuff into perspective, and Andrew did a great job of explaining what we've been doing and how we've been shifting, especially our bond holdings towards more interest rate rising friendly holdings that we would consider fixed income. But Andrew had mentioned something like why are we doing what we're doing, or why aren't we doing something different? And we've been asked those questions a couple of times in the last week. I firmly believe that our portfolios that we currently have are the right portfolios to be in. And there's very specific reasons for that. Number one, they are highly, highly diversified. And although they've been capturing a lot of the downside that the market's been handing us, they are also, the way we look at it as a longer term perspective, we certainly don't look at this month to month or week to week or anything like that. Interest rates are actually historically right on schedule to start rising. Now, we've had a sharper rise in the short term of interest rates than we were expecting, but interest rates do have some volatility. And if you've ever heard me explain bonds to you, bond prices have a direct inverse relationship to interest rates. And because the stock market has been going down, the stock portion of this, and interest rates have been going up, that's the reason why the bonds and the stocks both have gone down at the same time, which is pretty unusual. They tend to also go in inverse with each other. But there's quite a bit of talk, and that we're kind of maybe topping out on the interest rate part. That means that we can be expecting interest rates to come back down. And so the reason we've stayed in the positions that we've stayed in is, especially from the fixed income portion, is because they're all, when the interest rates come down, that portion of the portfolio is also going to recover. The last thing that we want to do is to take away something that's on the downside and then go into something else and then actually take loss. We know that interest rates will come down at some point again. Over the long term, they will be increasing, but in the short term, they will be coming down at some point. And also all the volatility is going on, like the whole thing in Russia. So it's because it's taken a lot longer than I'm sure Putin anticipated of trying to take over the Ukraine. Whatever ends up happening over there, as soon as that is over, that's going to take a lot of volatility, a lot of uncertainty out of the market, and that's also going to help the stocks recover some. And it's good to be exposed to entire sectors rather than individual stocks that we think that we may pay. Personally, I would have bet a lot on Amazon. They surprised us and they went down 15% last Friday alone. That's such a predictable stock. At least that has been. It's been stable. It's been almost predictable. The reason why we weren't quite affected by an Amazon or an event like that for misreporting or missing their earnings reports is that we're fully diversified and we're all over the place. So we're not prone to those highly volatile spikes that individual stocks offer. That's why we currently have and are intending on maintaining an exchange traded fund portfolio, which highly diversifies every holding of everybody that we have, that we manage money for. So there is light at the end of the tunnel. It doesn't seem like it is right now, and I completely get it. Like Andrew said, he's completely right. Nobody likes to see red on their statements. We hate it more than you do. We completely get it. We understand the anxiety that it brings, but we've also come off of a great run. And since COVID, since the recovery from COVID, with the economy has been on a tear. There has to be a breather. There has to be a pullback in the markets in order for there to continue to be growth. So this is definitely temporary. And everybody that we talk to, all the research that we pay for, all the smart people that we talk to that follow this stuff very, very closely, they're not really anticipating a recession until maybe next year, and they're anticipating a recovery later on in the year. And everybody seems to be saying that, and that's been a pretty stable statement from all the gurus out there that a lot of people listen to. I'm going to Car. Are you on with us yet? Andrew, he's probably not on. By the way, I'm sitting in a hotel room. I'm traveling at the moment, so I'm doing this off of an iPhone. So I'm limited as to what I can do as far as the technology. But Andrew, can you see if Car's on yet?
I don't think he is.
Okay. While we wait for Car to come on, does anybody have any questions or any comments that they'd like to make? Obviously, as your specific portfolio, we have to speak individually to you because everybody's a little bit different. But in general, does anybody have any questions for either myself or Andrew or David? And if so, unmute yourself. Okay. Well, I think Car's on, but he's muted. Car, can you hear us? I got a message, or like a message popped up that he's on. Okay. Melissa, is there anything that you may want to add? What are you seeing out there? You follow this stuff as closely as anybody else. Is there anything that you want to maybe add to this as well?
What I'm finding interesting is that savings bonds, particularly I bonds, have had a big jump in return. And so I think that that's going to signal the return of real money market interest rates, of savings rates. And so I think that that's a positive for everybody who's saving money.
The thing about bonds, and I mean, obviously, we'd never like to see these things go into the negative, but bonds, although they are a tradable instrument on the open markets, they spit out a fixed amount of money every single month or whatever the timing may be. And every time that they go down in price, percentage-wise, that amount of money that they spit out increases. So regardless of how low they can potentially go, and I don't think they're going to go that much lower because, again, we think that interest rates are almost topped off, if not at the top already. The further a bond goes down, the further the return, in other words, the yield of the money that it spits out becomes. So there comes a point in time where that yield is so attractive that people will eventually start going back into them, kind of as a safety, because if they're getting 3% at a bank or whatever, but a bond is now spitting out 6% of a yield, it becomes pretty attractive, and people will eventually start going back into them. So I think that part of the portfolio will come back sooner than we think, but what we'll have to see. And it's just we can't look at us from the short term, obviously. So, David, are you still with us?
Sorry about that. Nope.
Hey, Car, can you hear? There you are.
Yeah,
So,
sorry about that. I was muted and I couldn't get unmuted for some reason. It was weird. Sorry about that for the technology problem.
Yeah, not a problem.
Sure.
We've been, Carr was on another call earlier, and so he's just not coming on with us. And so we've kind of been talked about some technical things in the market and more of an overview of what we've done in the portfolios and what we're looking at, and kind of a perspective on what's really going on for the long term, that this will also pass. And obviously, hopefully sooner than later, we're certainly anticipating it to pass by towards the end of the year. But Carr, what are your thoughts? I mean, you look at this stuff closer than most people do, and you keep track of it very well. What are your thoughts on all of it, and what kind of light can you put on all this that's going on?
And I think you hit the nail on the head. This too shall pass very well. At the end of the day, we've got Russia, recession, inflation, interest rates, market decline, stocks down, bonds down, all the usual big ones, right? And people ask me all the time, I'm just hearing so much about recession. Well, quite frankly, recession doesn't seem to be on the near-term horizon. It really doesn't. At the end of the day, one of those there's two big key components, and that's slowdown of GDP and unemployment. And pretty much if you want to work, people can work. So we don't think we're too close to a recession this year. We think this too shall pass. Bonds and stocks being down at the same time, it is unusual. I get it all the time, people saying, oh, well, this has never happened before. No, it has. We've seen it. It reminds me of the old song that says, we've been everywhere, man. And at the end of the day, we've seen it. And in fact, it really reminds me of year 1990 and year 1994. Most people on the call might remember 1990 very well because it was made very famous by one election line by George W. Bush. Read my lips, no new taxes. And with that came new taxes in 1990 that created a little bit of a hiccup in the market. I call what we're going through a hiccup in the market. Created a little hiccup in the market with both stocks and bonds and a mini recession. And then 1994, we had another one. Stocks and bonds both down that year. And by the end of the year, by the full 1 year period of both of those years, all the hiccup had gone away and went back to normalcy. And then what happened in 1991 and what happened in 1995. And so the way I'm going to put this is coming to a theater near you is what happened in 1991 and 1995. The 12 months following a major decline where we are, the NASDAQ is down 20% year to date. So when we have a decline, the incline as we come out of that 1 year later is typically up 30%. That's a 3 and a 0. What happened in 1991 and 1995 were both way over 30%. So I think what we could have could be a strong recovery once we get the Russia-Ukraine thing behind us, once we get inflation to level out, which we're already seeing signs of inflation starting to level out. Midterm elections, all those kinds of things. There's so many things in the theater near you, coming soon to a theater near you kind of thing that are not bad. Like I said, one of the problems with a recession is employment and unemployment, if you will. And then the slowing of GDP. The slowing of GDP really refers to corporate earnings. If we really think about everything we do when it comes to investing, it's that old mantra of, in real estate, location, location, location. In our world, it's earnings, earnings, earnings. As long as companies are earning profits, that's good for the overall economy and good for the overall investors. And last week was a good example of a sector that had shifted, that did really well during COVID. Amazon. We all bought stuff from Amazon. Last week, they disappointed us with earnings. They still made a bunch of money, don't get me wrong, but they missed on their earnings number because people went back to buying stuff in stores. And that's a good example of what we need to kind of always be on the lookout for as we look forward, not backwards when it comes to investing. Look forward to the way things are going to be, not backwards the way they were. Oh, we should be invested in Amazon because Amazon is, going to be the only way people buy stuff. Well, no, it was the only way to buy stuff during a pandemic. It's not the only way people are always going to buy stuff. So that's kind of the way we want to continue to think about things on a going forward basis. So kind of a little bit about where we are. We think that the future can still be bright for sure. Is there risk out there? There's a mutual fund company called the American Family of Funds, and they used to put out a report that showed all the negative news throughout history on the bottom. And then it showed what happened to investments just in general throughout that whole time period. And every year you can come up with something through the years: Watergate, Nixon, Vietnam, 9/11, the 2008 crisis, all these kinds of things. And the way our system works, we come through those and we come out. What that does is it gives us opportunities to weed out the weak and continue with the strong. And that's where we are, and we'll be continuing to grow over the future. So it does take during this time period. I know we've tweaked the portfolios here and there, and so it does take some tweaking over time. But as a whole, if we think about where we are today, between today and mid-summer at some point, great time to be investing. Maybe one of the best times to be investing in the last couple of years, other than March of 2020, March and April of 2020 during the peak of COVID. Other than that, a great time to be investing if you have idle cash on the sideline. So anyway, that's my basic thoughts.
Yeah, that's a great point. For all the retired folks that nearing retirement, we set up the asset segmentation techniques where you have cash available in order to live off of. So we've already kind of planned for all this kind of stuff. And I know we always say this, but this is when it really comes to light. It's almost irrelevant. The market keeps growing and growing and growing like it has in the past few years. But being in a segmented type of portfolio, like all of those who are retired and or getting near retirement, you're going to be there. This is exactly why we do that, so that you don't have to worry about it. Because, like I always say, markets. One thing I can guarantee: markets return 100% of the time. They do not ever stay where they are. And for those of you that are invested like that, and then 99% of you are, that this is exactly why we do it. And I would say for the younger folks out there, the younger pilots, flight attendants that are on the call and that we manage money for, man, this is a great time to invest, because I guarantee that the market will recover. Markets recover 100% of the time. It's just a matter of time. So when the markets are down 10, 15%, Nasdaq's down over 20%, it may be a good time to start, maybe not invest fully into the market, but we'll do something called dollar cost averaging, systematically put an amount in. Your 401k is exactly what you're doing. Don't stop putting money into your 401k. But more importantly, I think don't chase returns, because you can always find something in the rearview mirror that, oh man, I should have done that, or you should have done that. The reality is that the market as a whole will come back, and it's very difficult to stock pick during a time like this. In fact, I think it's virtually impossible. We're looking at certain sectors that we may be going into, specifically consumer staples, maybe some energy as well, maybe financials as well, because of inflation, all those things. We haven't made the decision to actually implement that, but we're looking at it. But that we're not really stock picking, we're trend picking. But for those of you who are younger, please continue to dollar cost average into your 401ks. It's extremely important. The performance will pay off in the long run. It will pay off huge. And if you have questions about anything, or how to do that, or how to take advantage of something like this, please give us a call. I mean, we're here to advise you, and this could be something we can take advantage of, especially if you're working and you're younger and still building your wealth. So I'll kind of leave it at that. Anybody want to add anything to that? Andrew, David, Melissa, Austin?
Well, appreciate everyone. I do want to throw some operational stuff out there. This time of year, everyone should be getting quite a bit of compliance mailings, annual notices, privacy notices. Some will come from LPL Financial, some will come from Schwab or Fidelity, and some will also come from Symphony Financial. So just be expecting that in the mail. If you have any questions, it's just an annual required mailing. And again, if you have any questions about it, but for the long-time clients, you've seen it every year. For some of the newer faces, just keep an eye on that, and just know it's a required mailing, but doesn't necessarily require any action from you. So always available for questions.
Yeah. So again, guys,
I have a question.
Yes, sir.
This is Philip Ford. I'm
Hey.
wondering. Hey, how you doing? I'm wondering
Good.
if the uptick in COVID is going to affect the market at all. There seems to be a trend in certain states that another variant is on the way. Would that affect investments at all?
I think the new norm is probably that we're going to hear about variants for some time. I think more in terms of impact to the market is countries like China, who actually have the ability to lock things down again. That could, again, have caused some blips in the supply chain like we saw into 2020, and things are loosening up a little bit. But in terms of a state-by-state basis, obviously we can never say never, but I think the resiliency that people have kind of shown, at least through the last several quarters, of I wouldn't say getting comfortable with COVID, but getting familiar with what it really means to catch COVID a couple times, or potentially come out on the other side. I don't want to minimize the people that have been affected terribly by the disease. Obviously, it gets people in different ways, but I don't see a large impact to the U.S. barring some incredible new variant that isn't able to contain. The state-by-state reportings really have a nominal impact, but again, supply chain was opening up even in China, and even though things have kind of gone the other way here recently, it's something that I think economies are better prepared. There's more information every day on it, and in terms of protocols, and even the CDC's guidelines has evolved through the country. So I think in general, we don't see that being a headwind heading into the summer.
Yeah. And I think that's a great point, Andrew. You say that there's more information out there where this is not a new thing anymore. And when there is COVID, as the economy has shown, business always will prevail. Business adapts to whatever condition is out there. This is why also political environment doesn't really matter in the long term, because no matter what administration is in the office at any given point in time, business always prevails. No matter what they do, they will adapt. And so we look more at the business end of it. I agree with Andrew. I don't think COVID would really affect the markets at this point. I'm more looking to the emerging markets around the world with the Russia invasion of Ukraine or all those types of things, rather than worrying about COVID too much. I don't think it's really on too many people's radar. At least I haven't heard about it in terms of it affecting the markets. I'm not saying that it couldn't, but if it does, I don't think it will be anything of significance compared to the other things that are going on.
Okay, copy that. Thank you.
Yes, sir.
Thanks
Did
for your
anybody else have any
Bill.
questions? Okay. Well, I guess we'll go ahead and end it there. Please give us a call if there's anything that we can do for you and answer any questions when it comes to your specific situation. We appreciate you guys. We're right there with you. We understand that's not a fun time, but these are the times that we have to go through to come out in the green on the other side. This is not new. These things happen all the time. We just haven't had them in quite a while. So it may feel like it's different, but at the end of the day, it's just a negative period in our market that we have to get through to get back into the green on the other side. So please hang in there. You are where you're supposed to be in terms of the portfolios. I can't think of anything else that we could be doing that would be better. And we just wait for things to improve. And we absolutely do believe that they will here shortly. It's not going to continue on forever. So if you have any questions, once again, give us a call. We appreciate your time. Thanks for joining us. I know it's late in the day. And unless anybody has anything else, we'll end it right here. Okay. All right, guys.
Thank you, everyone.
Thank you, everybody. Appreciate it. Have a great day. We'll look forward to hearing from you. Thanks.